too.
And that is a great set of earnings. So the profit has gone up by 12.9% on a quarter-on-quarter basis, much higher than the 0.8% that we were estimating. So once again, we'll watch for whether the margin expansion will continue in HCL Technology. So I've got the earnings with me. Let me quickly run you through that. The key earning to flash for will be the dollar revenue growth. It's gone up by 3.4% on a quarter-on-quarter basis at 1,407. So that is the dollar revenue growth. 1,407, a growth of close to about 3.4% on a quarter-on-quarter basis. Revenues have gone up by 0.9% at 8,424. So I hope these earnings are flashing on the screen. Yes. Rupee revenue up 0.9% at 8,424, and the net income, as you pointed out, is up 13% at 1,834. So let me just quickly run you through what the EBIT is. The EBIT is coming at 7,933. So that is what the EBIT is, 7,933. So this turns out to be a percentage growth.
2038 is the EBIT number, Rima, versus your poll of 1992. So the EBIT number has gone up considerably. 2038 is the EBIT number. So that would mean a significant...
2038.
Yeah, 2038. So
I think you were reading the full year EBIT.
Yeah.
Yeah.
I was reading the full year earnings, so the EBIT percentage is coming at 24.2%. So this is a handsome beat compared to what we were estimating. So it's beaten our expectations by a good 60 basis points. And this perhaps is marking, a multi-quarter beat.
Oops, there seemed to be some problem over there. We'll just try and get back to Rima. But these are a really good set of numbers.
The EBIT margin coming in at 24.2%. Her poll had thrown up only 23.6. So clearly, margins also have not taken a beating. I mean, it's natural in this quarter because of wage increases. All of them have seen a bit of a crunching of their margins, but it's much lower than what the street was working with. So HCL Tech numbers, you will have to say, are a big beat on profit as well as on margins. Rima, I believe technology is once again working on your way.
Indeed. I hope you all can hear me this time around. I'll run you through with the other earnings. America has gone up by 1.3% on a quarter-on-quarter basis in constant currency. It's Europe which is fired for them with a 7.4% increase on a quarter-on-quarter basis. So Europe seems to be the big driver, and we saw that even in the case of TCS, where both UK as well as continental Europe had seen a growth of about 4.5%. So Europe is doing well for HCL Technology for the second consecutive quarter with a growth of 7.4%. Let me quickly pull up how infrastructure services is doing. So that has gone up by 3.7% on a quarter-on-quarter basis. Remember, infrastructure management services contributes less than about 30% to its revenue, but has contributed close to about 60 to 70% of the incremental revenues for the past many quarters. Now that growth is coming at 3.7%, slightly lower than the run rate that it's been clocking in over the last few quarters. For the last 2 quarters, the average growth in infrastructure management services was at 5%, and prior to that, it was at 9%. But IMS still continues to grow healthily for the company with a growth of close to about 3.7%. It's application services, which has gone up by 1.5%, so fairly steady. The reason application services is important because this is it's largely their core software services, which has been lagging for the last many quarters. Only in the last 2 quarters, it managed to post a steady set of performance in application services. This time around at 1.5%, it seems pretty okay. What's fired for them is business services, which has gone up by close to about 17.7%. In this quarter. Financial services doing very well, so it's a 9.3% growth that they've clocked in. So financial services doing very well for HCL Technology in this quarter. And remember, even in the previous quarter, it was a growth of 6.8% that they've delivered. Manufacturing has contracted. Life sciences up 0.9%. Retail is up 2.9%. Telecommunications has done well with a growth of about 10%. So the key highlights is infrastructure still continues to grow decently, but the growth rate has come down. Application services has had a decent quarter. It's Europe as well as financial services, which is fired for HCL Technology. HCL Technology has signed 50 transformation engagements with more than $5 billion of total contract value in FY14. So in the last 3 quarters, they had indicated that they've been winning $1 billion each. So for the whole year, they managed to clock in $5 billion. So that is a positive. So these are few of the earnings. We're still awaiting. Okay, so now I have how the quarter ended has done. As we pointed out, the The margins have done very well. So 24.2% is a beat compared to street expectation. So the margin performance for HCL Technology continues. Revenue growth at 3.4% is lagging compared to what TCS had delivered at 5.5%. But it's slightly better than the 2% that Infosys had delivered and 1.2% that Wipro had delivered. So at 3.4%, it's slightly lower than the 3.7% that we were estimating, but it's okay. So we would still take the dollar revenue growth in line. The street would be excited with the margin outperformance, which has continued for yet another quarter, and it's slowly and steadily bridging the gap, with peers like Infosys. So I think Infosys in this quarter had clocked in a margin of close to about 25.1%. So HCL Technologies is at 24.2%. So it seems to be bridging the gap. So overall, these are good set of earnings. Dollar revenue growth slightly shy of street expectations, but it's a decent growth of 3.4%. And margin outperformance has continued for another quarter, with the key drivers for the quarter being Europe, which has done exceedingly well, as well as the financial services, which is a growth of close to about 7% that they have clocked in. With that, I'll hand it back to you while I can pour over some more numbers.
Just pour over the numbers. Don't go away, Rima. Your wrap of the key highlights
is the...
Yeah, please go ahead.
Constant currency growth has come in at 2.8%. So that also is, a fairly positive set of earnings number.
Okay, but that's a bit lower than what they clocked earlier, isn't it? A constant currency growth at 2.8%. I think the previous growth was over 3%.
In the previous quarter, the constant currency growth was at 2.9%. This time around, it's at 2.8%. So it's okay. Dollar revenue growth has not been at the top end of the peer group range for the last 2 quarters at least. So even in the last, quarter, it was better than what TCS had delivered, but it was slightly lower than Tech Mahindra. So Tech Mahindra will await. But, dollar revenue growth is okay. The company once again has managed to improve its margins. What we're awaiting is how SG&A as a percentage of margins is done.
Okay, just hold on to that. We'll just go across. You pour over the numbers. We'll just get one take from Pramod Gubbi of Ambit, who joins in now. Pramod, your prima facie take on the numbers. I mean, it looks like a very good set of numbers. Profit growth of 12%, dollar revenue growth of 3.4%, and the margins too at 24.3%.
Yes, indeed. I think the top line growth is broadly in line, or in fact slightly better than what we had been estimating. So that looks good. In terms of the breakup, I think IMS, which has been pretty much the leader in terms of their service line for growth, that's also done about 3.5, although lower than the previous quarters. It's broadly ahead of the company average. But the big beat, in our view, is on the margin front, where we are expecting some sort of hit on the margins because of the rupee depreciation and perhaps some large projects going into transition mode, which often involves some costs. This sort of an uplift in margins is clearly the big surprise from this results from our point of view.
Pramod, I know you'll be awaiting more numbers and more management talk, but prima facie, you think that this calls for bridging of valuation gaps with the leaders?
Yeah, absolutely. We've been suggesting or anticipating that for quite a while now, because it's been a fairly long time, about 2-3 years now, that HCL has consistently outperformed the sector, or at least matched up to TCS, the sector leader. We don't see any reason why it should be trading at a discount to either Infosys or Wipro. May not be at the same levels as TCS, but clearly this again calls for yet another re-rating for HCL Tech.
So what might that be? What might price targets or growth targets be hiked up to?
Look, based on our numbers, FY16, we see based on current share price, it's trading roughly about 14 times earnings. Infosys and Wipro are roughly at 14.5, 15 times earnings. So the first leg should be that gap should be bridged. There's absolutely no reason. Wipro is broadly staying flat this quarter, and at best they'll do about 10% growth, whereas HCL Tech should do north of 15% growth for this year. So that's the sort of difference in growth levels. So the first leg should be crossing Infy and Wipro's valuation. Our sense is more like 16, 17 times earnings, which is a good 20% upside from these levels. Should be the re-rating potential for HCL Tech.
Okay, so where do you stand as far as the FY15 EPS goes, and would you scale it up higher? I mean, I understand that the consensus EPS is at about 93 for FY15 and about 100 to 101 for FY16. Do these results present a case for the EPS to be scaled up higher?
Look, we have been quite bullish on HCL Tech, and our numbers have always been ahead of consensus. Our numbers for FY15 are 101 already, and FY16 is 115. We'll take a look at what led to this margin beat and decide based on that whether there's any scope for upgrade. But at this stage, we'll stick to these numbers, 101 for FY15 and 116 for FY16.